Today I have the pleasure of being joined by Brian Cogan with Bank of America Practice Solutions. Brian and I have known each other for a number of years, a long time now. Done a lot of deals together under the belt. And what we do is generally we'll get together a couple times a month and just keep each other updated as to where the industry is, what I'm seeing, what he's seeing. We have different takes on the industry a lot of times, see different aspects of it. So it helps us to stay together to know what's happening and what's on the forefront. So Brian is one of the first touches that a lot of our clients or potential new owners will have. Having that conversation early on with what is a buyer able to do, what do they need to do is very important. So I appreciate you letting us record this. This is a conversation we can have and send out to some people and let them see it and get a good idea of what you expect, what the bank expects from a lending standpoint when we see those young buyers come in. I think it's an important thing to see.
Sure.
So what I've done is I have a list of common questions that we get. You've heard them all before, but you have a really good insight into each of these. And I think it's important for people to hear them. So what I'm going to do is I'm just going to go down the list. I'm going to ask these questions. I think we can talk about them. We won't go too long-winded on them, but just, again, getting that information out into the industry, letting these young borrowers hear what you expect of them, what the lender expects is going to be helpful. So to start it off, what is the current appetite of lending in the dental industry right now? What are you seeing? Kind of where's the market? What's going on?
Yeah, no, absolutely. That's a great question. I mean, I think now that we're in 2020, we're probably in one of the best markets that we've seen in a really long time, and probably in most of our lifetimes. So, from a dental lending perspective, banks and lenders like Bank of America Practice Solutions are very aggressive in the market to lend to dentists in this market. We're seeing from a loss rate perspective, some of the lowest loss rates probably ever in the history of Practice Solutions, well below 1%, which is kind of what the market's always kind of trended at, is roughly around 1%, and we're probably less than 0.5% for loss rates right now. So the bank is very aggressive in lending, and I think there's no better time right now for a young borrower, buyer, to come with interest rates also being at pretty much historical lows in the last 20 to 30 years. So a great time for the market.
Right. So the lending side is not a reason someone should delay getting into ownership.
No, absolutely not. I think that's one of the biggest misconceptions is I sometimes hear younger doctors that are coming out of dental school or a couple years out of dental school, and they've heard rumors that they have to go work for a DSO or they have to go work for corporate because they're never going to be able to get money. I think everybody's personal situation is a little bit differently, but you need to have those conversations. Don't just listen to one person and what they're telling you, and take that kind of fear into not moving forward with potential practice ownership.
Yeah, absolutely. If ownership is something that you want, that you're looking for, really the only way to do it is to get out there and own something and to work with the people that can get you to ownership.
Absolutely.
And with you guys being one of the big players in that. All right. What can a potential practice owner looking to own in the next year or so help to do to position themselves to be attractive?
Sure. No, that's probably one of the biggest questions that I get, whether it's someone coming right out of dental school or somebody maybe that's been practicing for 2 or 3 years as an associate and looking to take that step. My recommendation, no matter if you're a year or two out or 6 months out from looking to potentially get into practice ownership, is start having a conversation with someone like myself, a lender, to kind of understand what does your overall financial situation look like, what does your professional situation look like, and what would there be any restrictions or limitations on financing for you at this point, because the earlier that we can have those conversations, we can kind of direct you, whether it's something maybe in your professional history from production or income, or something in your personal financial situation.
Right.
And the earlier we can have those conversations, we can kind of get you on that path so that maybe today you might only be pre-qualified for $500,000. In the next 6 to 12 months, we can get you to be $1 million buyer. So again, there's lots of things that as we go through the process and we look to pre-qualify a buyer that we look at. But I would say the main things, as you prepare for practice ownership is, understanding your production as an associate. How's that going to correlate to the practice that you might be looking to purchase. Obviously, if you're looking to start from scratch, production doesn't play as big of a role because you're going to build that practice up from the ground up. And then obviously on the financial side, understanding kind of what your personal debt might look like from student loans to a mortgage payment, and then looking at the asset side, and have you had a chance to kind of build up some cash reserve, which always makes it easier as we go through the pre-qualification phase.
So just being smart early on.
Absolutely.
Really.
Yeah.
Just watching the financials, avoiding decisions that may impact your credit negatively, living off credit cards, all those things are things we really want to avoid and wait, because that first snapshot you take of that buyer is important. But that's why, that was one of the questions, you kind of got into it early, is when does a borrower start that relationship with you? And the earlier the better,
Yeah.
because that borrower may not be looking to get a loan right then, but getting in and understanding that this is what I need to look like to get that loan, being a year in or a year out or whatever it may be, helps tremendously.
Absolutely, and I think that I've had conversations with buyers before. They say, I was told to give you a call. I don't really know that there's anything you could help me with at this point. I've been told that you just go to the bank once I find a practice to purchase, and I totally do not agree with that at all. My recommendation, obviously I speak at some of the dental schools and have conversations with them. I tell the dental students, call me 6 months after you've gotten out of dental school and you've got an associate position, you're starting to make some income. We can really kind of start taking a look at your application and understanding where you sit. And I guess the term I always use is baseline. Like let's set a baseline for where you are today, and you might be qualified for $500,000 today, but we can take the steps and start to help build that application,
right.
Grow your production, grow your income, grow your cash and savings. And again, in that time, whether it's 6 months, 12 months, 2 years down the road, you're going to have no issues at all and be able to get financing and get the best financing terms and rates possible.
And I think that's what differentiates you as a specialized lender in the industry. Is not a one-hit scenario. Of course, the end goal is funding and practice ownership, but being in the industry and really understanding it allows you to help these doctors get in, position themselves, really set themselves up for success, and then later in the relationship, after you've built that relationship, then that's when the funding happens.
Yeah.
So it's really later on. I think a lot of young borrowers think, and it's true, but they think, okay, I need this person for this person for this, and they kind of already have an idea of what that advisor is going to be able to do for them. But having those professional relationships, you being one of those early on in the process, even if they're not buying for a year or two or whatever it may be, is important. Because like you said, getting them on the right track is very important.
Absolutely.
Talk to me about student loan debt, because a lot of young doctors coming out, it's just this nature of the beast. They're going to have the student loan debt. It's part of it. And when we talk to a lot of young doctors, that is one of their first concerns is, I have student loan debt. How can I get into ownership when I have to pay off this student loan? I have these payments. No way a bank will finance me buying a practice if I have this student loan debt. So talk to me a little bit about that, how that has, if it does impact it, how it impacts it, and what you would suggest to those borrowers.
Yeah, that's another obviously huge question that I get questioned up front a lot of times, whether it's, again, dental students or associates a few years out of dental school. This is one topic I would say that has definitely changed over the last, say, 2 to 3 years from a lending bank perspective. Up until probably, again, 2 or 3 years ago, it didn't really matter how much student loan debt. Like, again, at that time, student loan debt was reaching probably $400,000, maybe $500,000 at the absolute most. And what we've always said is that it's all about cash flow. If you're buying a practice, you want to have enough income to be able to support the monthly obligations that you have. So it's more about getting into a monthly payment that's manageable with your student loans. But now, again, as we're seeing the trend, and I think we're seeing the average student loan debt is creeping up, upwards of almost $300,000 for your average dentist. We're seeing residents now come out that have $500,000, $600,000, $700,000 in student loan debt. It's becoming more, I would say, more difficult for someone with that higher student loan debt balance to get financing right out of the gate. So I think our threshold, if you're under $500,000 in student loan debt, we're going to be pretty comfortable with someone, a year out with, a year of associateship behind them. If everything about the deal makes sense, we're going to lend to that opportunity. As we get over $500,000, we're going to take a little bit of closer look and understand all the other aspects of the transaction, looking at the personal financial statement, looking at the production history. So I would say as we get over that $500,000, $600,000, $700,000 range, we're probably looking for someone that has a little bit more work experience and paying down the debt a little bit over time before we're going to be more comfortable in lending to that type of customer.
Yeah, and this goes back to that early relationship, having the conversation, because what we tell our clients, especially the young ones looking to own early out, is at least have the conversation. We understand that you're saddled with this student loan debt, but we can't tell them, yes, that's going to impact you buying a practice or not. That's really a conversation they need to have with you. So starting that conversation early, again, that's just another point, another reason why to do that. All right, another one that I get a lot, and again, it's more, I think this goes more to the jargon of it, is tell me the difference, or explain to us the difference between a pre-approval and a pre-qualification, because there is a lot of misunderstanding in the market about that. We'll have doctors that call us and say, "Oh, I've got I've been pre-approved," and so that's always a question that we get. So talk to me a little bit about that. What is that?
Yeah, I mean, I would say that a pre-approval and a pre-qualification are, in my opinion, the same thing. The only difference that I would tell you, so for me, a pre-qualification is essentially a customer that has really no opportunity in front of them. They really want to just understand, again, what that baseline number might be. We have a 2-page form that we have them complete, again, giving us some information on them both personally and professionally. I can look that information over within 24 to 48 hours, have another follow-up call, and really kind of go through all the aspects of the application and give them that ballpark number. As long as the practice you identify were to meet everything we were looking for, cash flow is good, we would approve your transaction for up to $500,000, $1 million. That's a pre-qualification. A pre-approval, I would say, is more tied to a doctor that might be looking to start from scratch. When they're looking to start from scratch, we can physically give them an approval that we will lend them, let's say, upwards of $500,000 to $600,000 to start a practice from scratch without really having any data on that location. Okay. That pre-approval would then be conditioned with having to have a draft of a lease, having to have a few other items that we would require, and then once they have those in place, then essentially the loan it doesn't really have to go back through underwriting, but it now meets the requirements that we put in front of them. And so we use that term more for a pre-approval on the startup side, where on an acquisition we would use the term pre-qualification, and then once they identify a practice, we would take the practice with their application to get them an official approval for that transaction.
I always suggest that if we have a young client that's looking to buy something, that they go through the pre-qualification process, and I assume you would do the same thing.
Yeah.
I mean, if you really think about it, it's kind of like getting an okay from your bank to buy a car. Then you can go out and really start looking and be competitive. And as you know, the marketplace right now, as far as acquisitions, is extremely competitive. So doing anything you can to edge out the competition for a high demand location is absolutely worth doing. And like you were saying, it's a short process. It's a quick turnaround. There's really no reason, even if the buyer's not 100% certain they're going to buy this location, or they might not buy this year or next year, go ahead, get the pre-qualification, understand where you are financially, let the bank give you the okay, then at that point work. From my side, the brokerage side, on the legal side of the acquisitions, it's a heck of a lot easier for us to know that we're moving forward on a deal if we have somebody that's already pre-qualified.
Yeah, and through that process, we actually do not pull a credit report on you. So I know that's a fear a lot of times from younger doctors. I don't want to have my credit pulled too many times. I might be looking to buy a house soon, or a car, or the more credit gets pulled, the lower my score becomes. So at that point, again, we understand, because we just lend to dentists. In a given year, I can probably count on one hand of the doctors that don't qualify based on a credit score. Obviously, in today's world as well, most individuals probably have a rough idea what that credit score is going to be. Our guideline typically is 680 or above. That's what we feel average credit is. And like I said, working with dentists, 99% of the time their credit score is going to be higher than that. So we don't need to actually pull that credit right away to get you the pre-qualification. There's no fees, there's no obligation, there's no reason really not to go through that process up front to be able to position yourself again in a competitive market, so that when the right opportunity comes, you can move quickly, because we've already collected essentially 50% of your application at that time, and we can collect a couple other items and move quickly with underwriting.
Okay. You touched on it briefly in that, but talk to me about practice startups. Mm-hmm. So if we have, again, because the market being as tight as it is, there are a lot more people looking to get into ownership than there are existing opportunities. So what we have seen is kind of a resurgence in cold starts or scratch starts. Find a location, upfit it, build it out, put the equipment in, and then start from the running from the ground. So what's that process like for you? What do you like to see? Is there anything really different that someone looking to do a cold start should be doing?
Sure. I mean, I think, like you said, it's definitely probably, we're seeing it on the practice solution side. It's definitely becoming more popular. And I think the biggest thing, especially in some of these areas across the country where, again, it's been very difficult, the demand for practices is very high. The inventory is very low. And we're seeing young doctors that are pre-qualified for 2, 3, 4 years, and they realize I might never be able to identify a practice. So if I want to get into practice ownership, then starting a practice from scratch is going to be my best option. And I think, again, if you're in the right area, my number one recommendation obviously is again for us to kind of go through that pre-qualification phase. But I recommend, we do not require it, but I would always recommend getting demographics on certain areas. We work hand in hand with a couple different demographic companies that can either do it for free or for a very limited cost to get a rough idea of an area where you might be looking to go into, to understand what the competition is going to look like, what the growth of those areas are going to look like. And if you can get a good demographics around you, and then obviously you're reaching out to a commercial real estate broker that specializes in dental to start looking at spaces, you can. We've had some just amazing stories with some doctors that have done very well with startups over the last couple years that are in high growth population areas. The biggest difference for us on the startup is, again, typically we see our startups somewhere between $500,000 and $600,000 for a general practice. Initially, it is approved similar to a line of credit, so you have those funds there and available. You draw on them as you need. So we really kind of tailor that program to, some doctors can maybe get that startup done for $450, maybe they can get it done for $550. Your loan we're not giving it to you up front, and you're not paying the interest right away. You're taking as you need the funds, and in the end, once you've taken what you need, we then enter you into repayment, and you're only paying what you've taken at that time. We also help our doctors from a cash flow perspective by putting them into interest-only payments to start, and putting you into graduated payments, so that the payments in the first few years kind of step up as the practice is growing and as the income is growing. So like I said, we really have a great program on the startup side to really tailor it to your needs to get you into practice, and again make it feasible based on the current financial situation that you're in.
Yeah, I think that's something both of us will be seeing a lot more of in the coming years. That's really the only option.
Yeah.
All right, so Bank of America's underwriting, I know you can't really tell me exactly everything that they look at when they're evaluating an opportunity, but for those that are in the middle of doing due diligence themselves, so they found a practice they like, they're talking to you about financing, they're going through the numbers with their CPA, and they're working with their attorneys and doing all that. What is going on behind the scenes at Bank of America as far as the underwriting or evaluating the opportunity? What do you like to see as a bank when we're talking about the practice? We've talked about the borrower, what you like, but there are two parts, the borrower and the practice, and they need to work together for the funding part. So tell me what you like about how you evaluate a practice opportunity and what you like to see.
Sure, no, absolutely. I would say on the practice side, there's similar to the buyer side, there's probably 2 or 3 main items that we're looking at during the underwriting process. I would say one is looking at a consistent 2 to 3 year history of the practice, and looking at the revenues, and are we looking at a practice that's steadily declined year over year for 3 years. That can be sometimes more difficult to lend to, and I think the thing we look for is really kind of understanding where is the bottom of the practice. If a practice is continuing to decline and you have a doctor buying that practice and they're stepping in, I think everyone understands that there's always going to be a little bit of attrition as you purchase a practice. So if the practice is already declining and you have a little bit more attrition, where are we really kind of setting that baseline of the bottom of the revenues, and then that doctor can then kind of build it back up from there. So again, I think that we would want to see, obviously, in a declining revenue practice, that the practice purchase price would be somewhat in line with the decline. But again, just kind of really understanding what is going on, why are the revenues declining, how do we make sure that our borrower going into the practice isn't going to take any more of a hit to the revenues as they transition into the practice. The second thing, I think the biggest thing we look at is understanding the overhead of the practice and the profitability of the practice. When we dig into the financials, I mean, we get very deep into the expenses and really understanding, why are supplies 8 or 9% when industry average is roughly 6%. Lab fees, same thing. If they're higher, we want to understand, we want a story of why those expenses are higher than industry average. And if we have a good explanation, we can account for additional cash flow for our buyer in that transaction. So again, if it's lab fees are 10% because the seller's using a very high lab and our buyer going in is going to use a more reasonable lab, we can offset that cash flow. Understanding wages, is there any family being paid that's not going to be paid moving forward? So as I develop the cash flow or profitability of the practice, I typically tell my buyers I want to see you hopefully at a minimum on a general practice 35% profitability. We always know that there's going to be some personal expenses baked into the tax return that we're probably not going to be able to totally discover. But again, if industry average is roughly 39 to 40% profitability, we want to at least be able to show that we're at 35. Again, not everybody's personal situation is different. They still might be able to cash flow on 20% profitability, but we're at least addressing that with our buyers, our borrowers, so that we understand that practice. So, I would say those are the two biggest things I think in understanding a practice is revenues and overhead.
Yeah, and you do look at it as a whole. You look at the strength of the borrower and the strength of the practice, and those can help each other out in some scenarios. Yeah. All right, a couple more here, and I'm going to let you go. Ideal borrower. So if you could just have it your way, what would the ideal borrower look like to you?
Yeah, I mean, I think from our perspective, we're looking at at a minimum, we're going to want to see probably at least 12 to 18 months of associate experience, getting your hand speed up coming out of dental school, creating some good income in that first year or two as associate. Obviously, we would assume that the income's probably correlates to the production that you're producing, so getting some good production numbers. And I think, again, the question I always get is, what kind of production are you looking for? I think it really is, it's relative to the size of practice that you're looking to go into. Like I said, we want to show or feel comfortable that you can keep up with the size of practice that you're purchasing. So if you're producing $400,000 and the practice that you're buying is in that range, we're going to be easily comfortable and know that you can easily step in and not have any issues keeping up. A practice that's producing $1 million in doctor production and you're in an associate position producing $400,000, there's a pretty big gap there. So we need to kind of understand, is the seller going to stick around a little bit long, post sale to help mentor you and keep your hand speed up, and it can keep things going. And then I think the personal financial statement is the other item. Again, as we talked before about looking at student loan debt or making sure it's not above kind of the threshold that we look for. Looking at your other personal obligations from maybe car payment, for mortgage payment, making sure that those payments will easily be able to be made based on the income that you'd make as an owner. And then the last item is really kind of showing that you've built some cash savings, kind of that, I guess we call it the rainy day fund that you have behind you. And I think that's all relative to the size of practice. Again, how much financing do you need? The more the higher the purchase price, the more financing you need, the more that we would kind of want to see that you've saved up in that account. But again, the three main items that we look for the ideal borrower is going to be production, debt, and cash savings.
Yeah, and the production, just to go back to that for a minute, is important, and that's something that a doctor can easily track themselves. And for the doctor, it gives them a good idea of how they're trending, their professional skills, how they're increasing. But that is something that seems to have some type of a disconnect in the industry with doctors that are producing at a certain level versus what they're looking to buy. So we always kind of live by the saying that you don't buy more than you can produce. Mm-hmm. It's just a safe thing. Now there are scenarios, like you said, the seller's going to stay, or there could be a lot of other scenarios where there may be some discrepancy between the two that can be bridged. But overall, just being smart about the opportunities that you're pursuing.
Absolutely.
All right, last question for you. What's your advice for the potential owners out there looking to get into the market now?
I mean, as we kind of hit on it a little bit earlier in the conversation. I mean, I just think that it's never too early to start any process, whether it's talking to a lender, bank, talking to someone like Joe, talking to any advisor that you're going to have on your team, from, again, a lender, bank, an attorney, a broker, a CPA, maybe a financial advisor. Having those conversations as soon as possible and really kind of setting the stage. And I think Joe mentioned it earlier as well, is just the communication level and kind of putting a team behind you that's going to be able to help you get into practice ownership. And I think when a team that you have behind you all can communicate together and work with you to get you into a good opportunity, I think we've seen over the years that those doctors have been very successful and transitioned very well into practice ownership.
Yeah. And if they're successful, obviously we're successful. It makes more sense that way. Brian, great information. As always, I appreciate you sharing with me, keeping me up, sharing with everybody else, allowing us to kind of to make a record of it so that we can share this information. Brian's contact information will be linked to this, so if you have any questions, feel free to reach out to him directly and have a conversation. And thanks again.
Absolutely. Thank you.